What's up, penny boys and gals? It's your boy, What the Duck here, and it's time for another trading class video. So last week when we went over the basics of a call option and how to use hedging to protect your investments. Tonight, we'll be going over the Greeks in options trading. And our next class will be going over implied volatility. So if you want to catch up on any of the classes, subscribe to this YouTube channel and check us out at discord.gg/pennyboys. We have trading classes, cash giveaways, stock alerts, and so much more. So let's get right into it. What are the Greeks? Well, the Greeks are ways of determining how an option's price might be affected due to certain changes in either volatility and or stock price change. So what are the different types of Greeks? Well, there's a whole bunch. There's actually four main ones, and those are delta, gamma, theta, and vega. So what does that mean? Well, delta tells us how sensitive the option's price is compared to the stock price. So it tells us how much the option's price will change if the stock changes by $1, whether that be up or down. So for calls, the delta will be between 0 and 1, and for puts, the delta will be between -1 and 0. In theory, the option has a delta percent chance of expiring in the money. So in theory, the delta is the percent chance that the option has of expiring in the money. Gamma shows us how much the delta will be affected if the stock price changes by $1. Theta is time decay. The closer to the premium, the higher the theta goes, and the more your option becomes worthless. This happens throughout the trading day. It's not just the close or the open. This happens throughout the trading day. The vega is linked with implied volatility. It tells you how much your option's value is going to change based off of a 1% change in implied volatility. Like earnings dates, news, and etc. All that can affect this. That's why you might end up losing money on an option call, even though it is going up. This has to do with the implied volatility and the rest of the Greeks. So, let's go over an example of all these different Greeks I just went over for those of you who might still be a little bit confused, because this is really confusing stuff. So we're going to be going over this stock for our example. This is a call. You can see where it says call on the top for American Airlines, ticker AAL, with an expiration date of 9/18. The strike price is $13.50, and the premium is 94 cents there at the bottom right. So this would cost $94 to purchase this option because options are bought with 100 shares. So 100 times 94 cents is $94. Also, the current price of American Airlines is at the top, $13.34, right in the top center of the screen. So, in this example, the delta is 0.515. This means that if the price of American Airlines goes up $1 from $13.34 to $14.34, then the premium likely will go up 0.515, which is the delta. So that's 94 cents, which is your premium, plus the delta, 0.515. So it will be worth around $1.45 if American Airlines goes up $1. That's how the delta works, but it's not a guarantee, it's an estimate. The gamma in this example is 0.1561. This means that if American Airlines goes up $1, that the delta will then go up 0.1561. So the delta would then be 0.515, which is the current delta, plus 0.1561, which is the gamma. which is around 0.67 total. So your new delta would then be 0.67 once American Airlines goes up $1. Meaning if the stock were to go up another dollar from there, that the strike price would then go up to 67 cents instead of 51 cents. So basically, as the stock rises, the delta rises. And the gamma shows us how much the delta will rise. The theta is 0.034. This means that if everything holds constant, which means if the stock price, volatility, and other factors don't change, then the premium will go down by 0.034. This is known as time decay. And lastly, the vega is 0.0108. This just means that the premium will go up 0.0108 if the implied volatility were to go up 1%. This is usually brought about with earnings news, so on and so forth. So basically the delta goes up. The delta is what brings that 0.94 premium up. It determines how much the premium will go up if the stock price, the current stock price, goes up $1. The gamma shows you how much the delta will go up if the current stock price goes up $1. And then the theta shows you the time decay if everything holds constant. And then the vega shows you where the premium will go based off of if the implied volatility goes up 1%. So that's kind of how the Greeks work. I hope that helped. I hope it wasn't too confusing. If you have any questions, of course, you can always ask me at our Discord. I'll be answering any questions regarding the Greeks in the PBU section of our Discord. That's at discord.gg/pennyboys. If you're not in Pennyboys, then you can join us at that Discord that I just mentioned so that you can get in on our upcoming PBU classes, which soon will only be available to Pennyboys Premium members. We also have cash giveaways, live trading, and an amazing community. However, I will still be posting some content on this YouTube, so make sure that you subscribe. Give a like to the video if you liked this video about Greeks, and subscribe to that YouTube channel. You can follow me also on Twitter and Instagram. But the actual Pennyboys PBU classes will be available only for the premium members. So join us at discord.gg/pennyboys. Join me, What the Duck, and together we can make some bread.